Sony's stock price has shown strong growth lately, with a jump of over 20% since its dip in May. But is this really the best Sony can do? Sony's all-time high price was almost double what it is now back in the 2000s. Let's take a closer look at a company that everyone loves and try to understand if it's a good time to consider it for your portfolio. Important disclaimer: DukascopyTV is not an investment advisor. Before acting on any investment or strategy discussed, you should always do your own research and make your own independent decision. Now, back to the subject. Sony is a company with very broad interests and diverse investments, ranging from electronics and gaming to entertainment and financial services. Quite a feat for a company whose very first product was a rice cooker, and it flopped. Sony did learn their lesson from that initial failure. However, the tech landscape is changing rapidly, and companies must continually adapt to stay relevant. We can see it by taking a look at Sony's stock graph. Despite stable growth in recent years, Sony is far from its all-time high. The company's stock price in the early 2000s was significantly higher, primarily due to its dominance in consumer electronics and the booming success of products like the PlayStation 2 and Trinitron TVs. However, several factors led to a decline in its stock price. Increased competition from companies like Samsung and LG eroded Sony's market share. Additionally, product flops such as the Sony Connect music service failed to gain traction. Management issues, including strategic missteps and a lack of cohesive direction in a rapidly changing tech landscape, further hurt Sony's performance. Finally, the global financial crisis of 2008 and Japanese economic stagnation negatively impacted Sony's financial health. In recent years, Sony has experienced a resurgence, driven by its strong performance in gaming, image sensors, and entertainment. Despite this growth, it has not yet returned to its early 2000s peak. Sony has been exploring innovative areas like Web 3.0 and cryptocurrency, which could create new revenue streams and keep the company ahead of industry trends. What future innovations or expansions would you like to see from Sony Group Corporation? Now, let's take a look at Sony's impressive annual results. Revenues hit a whopping 13 trillion Japanese yen, which was more than 5% higher than analysts had forecasted. In addition, their earnings per share beat expectations by 4%. This is a great sign that Sony is doing well operationally and maintaining a strong market position. Sony's short-term performance looks strong. The company's recent financial results were better than expected, which is a good sign. The company is doing well operationally and maintaining a strong market position. Sony's revenue decline is a concern. The forecasted annual revenue decline of almost 4% is something to watch out for. It suggests that Sony may face challenges in maintaining its market share and could lag behind its competitors who are expected to grow. Sony's stable analyst sentiment is a good sign. The fact that analysts haven't changed their revenue and EPS estimates significantly is reassuring. It means that despite the expected revenue decline, they believe Sony is still performing in line with expectations. If you're interested in investing in commodities, stocks, crypto, indices, or bonds, you should definitely try Dukascopy. You can invest with just one click, starting with just $1. Sounds good, right? Simply scan this QR code or check the link in the description below to get started. Fill out the form and then make a video call with a Dukascopy operator. That's all you need to do to open your Dukascopy bank account. Your Swiss bank account with Dukascopy will be ready to use the same day. Strategic positioning and industry trends. Let's dive a bit deeper into Sony's strategic positioning and how it aligns with industry trends. This will help us understand why analysts are forecasting a revenue decline and what Sony might need to do to overcome this challenge. One of the reasons for Sony's past success was its ability to diversify into various sectors, from electronics to entertainment. However, this diversification also led to some challenges. Sony needs to find the right balance between expanding into new areas and focusing on its core strengths to maintain its competitive edge. The tech industry is driven by consumer preferences, which can change quickly. Sony needs to stay attuned to these changes and ensure that its products and services align with what consumers want. This includes investing in new technologies and improving user experiences. Now let's take a brief look at Sony's competitors. A lot becomes clearer once you see the whole playing field, not just the one player you're focused on. LG's stock price over the past year has seen a decline. Despite recent gains, the stock remains below its levels from a year ago. The trend shows volatility with periods of recovery but an overall downward movement. Microsoft has shown strong growth with a substantial increase over the past year. The stock exhibits a consistent upwards trend, reflecting investor confidence and robust performance in its core markets. The trend suggests significant volatility with a sharp decline at the beginning and fluctuating recovery attempts that haven't fully regained earlier levels. Philips has experienced a significant increase in its stock price over the past past year. Despite some fluctuations, the general trend is upward, indicating positive investor sentiment and likely strong performance in its focus areas, especially healthcare technology. Samsung's stock has risen by more than 20% in the past year. The trend shows a strong upwards movement, particularly in recent months, suggesting positive market responses to its performance and product innovations. Sony's stock has slightly increased over the past year. The trend indicates some volatility with a significant dip earlier, but recent recovery efforts pushing the price higher. In conclusion, Sony Group Corporation is a fascinating company with a rich history and strong operational performance. While there are some concerns about its future revenue growth, the company's stable earnings forecasts and attractive valuation make it a compelling investment opportunity. If you like this video, hit the subscribe button and join us at DukascopyTV, your essential hub for all things related to the biggest financial markets from around the globe since 2008. Here, we bring you diverse perspectives with our range of hosts and presenters, delivering top-quality content that's straightforward, independent, and without any ads. Thank you for watching, and see you in the next one. Bye.